Okay, so today's video is pretty straightforward. I'm not here to show you a holy grail system or anything like that. I'm just going to show you a simple tool that does one job really well. We all know that avoiding bad trades is just as important as finding good ones. The hard part is telling the difference between a real powerful trend and the move that's about to run out of gas. This indicator I've been using has been great for that. It essentially paints a picture of the market sentiment on the chart. It's not magic, it just gives you an extra layer of information to work with. The sentiment range MA by chart prime. And I'm just going to show you my honest take on it and how it fits into my process. First, let's break down what this indicator is actually showing us on the chart. It's pretty straightforward once you get it. You've got this main line that follows with the price, and it changes color. When it's green, that's the indicator's way of saying the momentum is generally bullish or upwards. When it flips to red, the sentiment is considered bearish or pointing down. Now, see that gray or white color, cloudy area between the price and the line? I call that the chop zone. Basically, when the price is stuck inside the cloud, it's telling us things are messy and sideways. It's kinda hands off or wait and see area. Okay, before we go any further, let's pop into the settings. I only make one tiny little tweak here. Under the length, its default is 20 and I just bumped that up to 21. Honestly, it's a minor change, more of a personal preference, but it feels right for how I use it. The other settings like ATR length and range multiplier, I just leave them as they are. They control how wide the chop zone is, and the default works just fine for me, so no need for overcomplicated it. So on the chart, it looks like this. Green line, we're looking for bullish moves. Red line, bearish moves. And when the price is in that gray or white cloud, we stay patient. You can see right here on this gold chart, price breaks out, the line flips green, and we get a nice clean signal. And this is really important. This does not mean you should blindly take every single signal it gives you. That's a huge mistake. Let me show you a perfect example of what I mean. See this right here? The overall market trend is clearly moving up, but look, we just get a red sell signal. Taking that would be fighting the main trend, and that's a quick way to get into a bad trade. So, the big question is, how do we know which signals are good and which ones we should ignore? That's where our second tool comes in. It helps us solve the exact problem, and it's also completely free. It's called the Elliott Wave Oscillator. Adding it is so easy. You just go to the Indicators tab in TradingView and search for Elliott Wave Oscillator. Now, to be honest, the default settings aren't really tuned for what we're trying to do here, which is just to identify the main market trend. So we're gonna go in and tweak the settings to get it work for our purpose. First, under inputs, we'll see SMA1. Let's change that from the default to 100. Then right below it for SMA 2, we'll change that to 200. By using these bigger numbers, we're basically telling the indicator to ignore the short-term noise and just show us the longer, more established trend. Next, we'll pop over to the Style tab. I like to change the plot to columns. I just find it way easier to see at a glance. Then you can set the colors to a simple green for up and red for down. So what does this actually tells us? It's real simple. When we see a green bars on histogram, that's a confirmation that the overall market trend is up and the momentum is bullish. And when the bars are red, it tells us the main trend is down and the momentum is bearish. Alright, so let's put this all together and see how it actually looks like on a chart. This is where the two pieces of our puzzle click into place. Here we are on the 15-minute gold chart. Okay, so right here we get our first potential setup. The sentiment line flips green, so step 1 is check. Next, before we do anything, we look down at our filter, the Elliott wave oscillator. And what do we see? It's also green, with the bars clearly above the zero line. So both of our rules are met. This is what a high probability setup looks like according to this strategy. For managing a trade like this, a common approach could be to place the stop loss just slightly below the recent swing low and maybe look for a target based on 1.5 risk to reward ratio. Okay, let's keep going. A little later, look here. The sentiment line turns red. Now a person with just one indicator might see that as a sell signal. But what do? We check out our trend filter. The oscillator is still green. That tells us the main trend is still up. So we're not interested in shorting. We just ignore the signal completely. Knowing when to sit on your hands is just as important as knowing when to trade. Alright, here's come another buy setup. Sentiment line is green, we look down, oscillator is green, everything lines up according to the rules. We take the trade and this one doesn't work out. It gets stopped out. And I have to show you this, because this is more realistic part of trading. This is no such a thing as a strategy that wins 100% of the time. This is where the discipline comes in. The plan is designed to handle losses. You just stick to the rules for the next opportunity. So we skip this next sell signal because our oscillator is still green, and then here we go, another buy signal appears. The sentiment line is green, our filter below is also green, and this trade ends up being a solid one. It's all about following the process consistently through the wins and losses. And of course, this is really important. Please remember, this isn't a financial advice. I'm just showing you how these tools can be combined to build a logical process.